Hello everyone, my name is AMELIA PUTRI from the Management Study Program with NPM 244111142, Management Class 24B. Here I will present material about the list of accounts and general journals. Chart of accounts. A list of accounts is a collection of accounts used by companies to classify and record all financial transactions. Each account represents a specific element in the financial statements and is usually grouped into several main categories. 1. Assets. Resources owned by the company, such as cash, accounts receivable, inventory, and equipment. 2. Liabilities. The company's obligations or debts to other parties, such as accounts payable and bank loans. 3. Equity. Owner's ownership in the company, including paid-up capital and retained earnings. 4. Revenue. Income earned from the main operating activities, such as the sale of products or services. 5. Expenses. Expenses incurred in order to generate revenue, such as salary expenses, rent expenses, and utility expenses. Each account is usually assigned a unique code for easy identification and recording. General journal. A general journal is a chronological record of all financial transactions that occur within a period. Each transaction is recorded using the double entry principle, where each entry has an equal debit and credit side. The main components of a general journal include 1. Date. Indicates when the transaction occurred. 2. Description. A brief description of the transaction. 3. Debited and credited accounts. Indicates which accounts are affected by the transaction. 4. Debit and credit amount. Shows the amount debited and credited. Example of recording in a general journal. Suppose that on July 1, 2023, the company sold goods in cash for 10 million Indonesian rupiah. Date. Description. Debit credit. July 1, 2023 cash 10,000 Indonesian rupiah. 000 sales 10 million Indonesian rupiah. In the example above, the cash account is debited because there is an increase in assets, while the sales account is credited because it reflects an increase in revenue. Steps to create a general journal. 1. Transaction analysis. Identify the account affected by the transaction, asset, liability, equity, revenue, or expense. Determine whether the account increased or decreased. 2. Apply the debit and credit principle. Assets and expenses increase on the debit side and decrease on the credit side. Liabilities, equity, and income increase on the credit side and decrease on the debit side. 3. Record transactions in the general journal. Write the date of the transaction. Record the debited accounts first, followed by the credited accounts, indented. Add a brief description to explain the transaction. Make sure the debit amount equals the credit amount. General journal format. Date, debit/credit, account, debit, credit. January 1, 2025. Account 1 cash, Rp 5, 000. 000. Account 2 revenue, Rp 5, 000. Description. Sales of goods in cash. Benefits of list of accounts and general journal. 1. Consistency. Ensures all transactions are recorded systematically and consistently. 2. Ease of tracking. Every transaction can be traced back to the journal. 3. Basis for preparation of financial statements. The information in the general journal is summarized into a ledger, which is then used to create financial statements such as balance sheets, income statements, and cash flows. Relationship to the accounting cycle. The list of accounts and general journal are part of the accounting cycle. This cycle starts from identifying transactions, recording in journals, transferring to ledgers, to preparing financial statements. Here are the stages. 1. Identification and analysis of transactions. 2. Recording in the general journal. 3. Transfer to the ledger, posting. 4. Preparation of the balance sheet. 5. Adjustment if needed. 6. Preparation of financial statements. Thus the material that I can convey. Thank you.